Jahangir Aziz, the head of emerging markets, economics research and commodities at JP Morgan. Jahangir, always a pleasure speaking with you. Help us make sense of all of these moving parts, because every day you have an announcement. Policymakers globally, market participants, companies are trying to make sense of it. The latest, of course, is a possible 10% additional tariff on BRICS countries and 50% on copper. How do you make sense of all of this?
We don't. Look, there is a very deep fundamental belief that this government has regarding tariffs as being critical to their way of thinking about economics. There is obviously a transactional part of it. You're probably seeing some transactional part of it with these announcements, these deadlines being shifted, but ultimately, this administration's one of the pillars around which their economic agenda stands is imposing tariffs. They have, including President Trump, has gone and said, yes, tariffs are going to be painful in the short run, but in the medium run, it is going to be better for the economy. Now, that's their view. So what we look at is, look, regardless of, which specific country is getting what tariff and how the trade negotiations are going on, our sense is that tariffs, which is effectively about 14.5% in the US right now, this is the average effective tariff rate, will eventually move towards 20%. It'll be made up of tariffs, these countrywide tariffs that you have right now, moving somewhere between 10%, which is their bare minimum that they have said, and the reciprocal tariffs that were announced, and tariffs on sectors such as copper, semiconductors, and pharmaceuticals, along with what we already have on steel, aluminum, and autos. Now, obviously, there are exemptions in all of these things. Our sense is that those exemptions will stay or will get diluted in part of those trade deals. But ultimately, the effective tariff rate has, in our view, another 5 percentage points on average to move up.
Jahangir, good evening to you, I presume. Yeah, good evening to you and Neeraj here, and lovely talking to you, of course. I just wonder if it's possible to wrap your head around all that's happening and try and make a hypothesis which you believe yourself would be very accurate, because the policies and the potential impact of these policies, assuming that they go through, itself is uncertain, right? I mean, even for the pharma today, he said we are applying 200% tariffs, but I'll give a year and a half for people to think about it and come back. Right. How do you kind of wrap your head around what the potential impact of something like this could be?
So again, it's the same argument. This is an administration which fundamentally believes that tariffs are the way in which it's fundamental to their way of thinking. So tariffs will go up. It is not just about raising revenue. It is about reshoring or onshoring, manufacturing that have been lost, and they deeply believe in that. So for us to think that that is not the direction that this administration will go, I think it is, dangerous, and it's a folly. And I think so far what we have seen is that despite all of the uncertainty, and uncertainty obviously is weighing very heavy on corporate investment, we do believe that uncertainty will play an important role in the coming slowdown in the US economy. Then there is a spillover into inflation, even though we haven't seen that because of the front loading that had taken place back in the first quarter and also right up through May. There will be an impact on inflation. The economy is going to slow down as a result of all of that. Despite all of that, I think the way we are looking at it is that, tariffs are here to stay. At what level? We think it's about 20% average effective rate. We will have to get used to it, or companies will have to get used to that.
Jahangir, good morning. Hiral on this side. 20% average is what you're pegging right now in terms of average tariffs. Where would you place India then, taking this 20% into consideration? And if you have to look at India, we're seeing it lead the global growth with a 6.2% GDP increase in 2025. So how are you seeing India navigate this aggressive tariff regime as well?
So India clearly will have to bear the brunt of a lot of that tariff increase. There will be a slowdown in exports going into the US. There will also be an increase in imports coming from the US, depending upon what is, quote unquote, that deal, a mini or maxi. We will leave that aside. But I don't think that India's problems is, or the slowdown that we are seeing in India is it's just, can just push it on to the tariff war. That is a headwind. There is no doubt about it. But India's growth has been slowing for a very long period of time. We had been talking about that. The manner in which CSO prints or publish or methodology it uses in calculating real GDP, there is an issue with that. And it is that which has kept the growth rate much higher than what it should be. Finally, we are seeing that slowdown take place. And it is much more to do with the fact that private investment in India is not picking up. I think we keep blaming our, exports or, trade war, and we keep moving to ad hoc things about, the banks are not lending, or the banks had overlend, and now the banks' balance sheets are clean, and now they'll be lending. And we have been talking about this, I don't know, since 2010. Private investment since 2010 has flatlined at 12% of GDP, and it hasn't moved. And that is the problem. I don't think that India's growth slowdown or growth, how the near-term or medium-term outlook is tied to anything more fundamental than the fact that private investment in India has just not shown any signs of life beyond that constant, stable 12% of GDP. And clearly that's not enough.
Quick last question, Jahangir, just from the perspective of the expectation that US will ultimately see a little bit of a decline in economic growth. And a lot of the data points that we've been looking at have not necessarily yet pointed to that. So I'm just wondering when you see that happening, and also in the context of China, we don't know what's happening there. As in, is there going to be a reversal? A lot of people have a question mark about that. So if the two largest economies in the world are likely to see slower growth, what are the implications for global trade, one, and capital flows?
Sure. So you're asking several questions. So let me answer the first question. Yeah. We do see a marked slowdown in US growth. We used to have a baseline where we did have a recession in the second half. We have taken off that from a recession to a mild 1% average growth rate for the second half of the year. But we do still see reasonably high risk for a recession, if not in the second half, maybe in the fourth quarter and the first quarter of next year. So that's on the US front. On the China front, we believe that China will struggle through, but will be able to maintain a 4.5%, 5% growth rate for the year. And because the government is feeling comfortable doing that, the government has stepped back on pushing on the policy easing policy easing pedal, and I think that's basically what is going to take place in the second half. Where in the second half of the year, because of the policy impulse of the first half is slowing down, second half will also slow down. And you're right. The two of the largest economy of the world will be slowing down, and that will be the headwind. But I think the bigger headwind, and it's a much more structural headwind, is when the country that had been the one who established the global trading system for the last 80 years takes a broad swipe at it by imposing these very high tariff rates. 20% average tariff rate by the US is a very high tariff rate. Recall that even as as late as in December of last year, we were looking at a 2.5% average tariff rate. Then global trade gets hit. And if you look at any emerging market country under the sun, including India, including Brazil, which are supposedly closed economy, almost every, both domestic investment, domestic consumption, and obviously growth is very closely tied to global trade. And this is something that you see over the last 20, 25 years. And in the last 20, 25 years, many countries have taken, counter-cyclical measures, on monetary policy, on fiscal policy, on structural reforms. Yet, the tight correlation between global trade and their fortunes have not changed. And therefore, if global trade goes down, then emerging market as a group and individually do not have any other meaningful engine of growth left. And I think that is a reality that they need to face, not just now, but in the medium term, if this world stays the way it is, where US is backing off protecting and enhancing free trade in the global economy.
Absolutely. Well made point as well. But thank you, Jahangir, so much for joining us on the show at NDTV.